Hello and welcome to the very first RE panel discussion. I want to introduce Davor. I've got Elyse with me, and I've also got Melody. And I'm Mike Crisp from LePage, Meadowtowne in the Halton Hills area. Our objective is really to provide you with stuff that's happening in real estate and really try to simplify some of those issues. We want to keep you informed, and we want to help you make a wise real estate decision. And we're going to try to really keep it short, and we're going to try to keep it simple. Why us and what makes us different? Well, I'll tell you, we all come from 4 different brokerages. We all also come from 4 different areas with Ontario. And as you probably can see, we're 4 different age groups, of course, me being the young one. But I'll tell you, we do have one thing definitely in common, and that's a passion for real estate. And also a common interest in ensuring that we can be fully transparent with what's happening within our industry. We're going to try to cover some topics with you that everybody's talking about. And this week, it's the mortgage stress test. And with that, I'm going to pass it over to Melody, who's going to give you the first update.
Perfect. Thanks, Mike. So I'm Melody. I'm based in Toronto, and I am with Forest Hill Real Estate Inc. Brokerage in Toronto. And I'd be happy to kick us off with the mortgage stress test. So I'll start off by giving a little bit of the history about it. In late 2017, the federal government introduced a mortgage stress test for anyone who was applying for or renewing a home loan. And if you're like nearly half the Canadians, you may not understand what the test is or who it affects. And with the announcement made last year on April 6, 2020, there was even more confusion among Canadians. In other words, if you have a mortgage or plan to get one, the stress test applies to you. So what is the stress test? First off, it's not really a test. Rather, it's more of a set of rules banks must now use to determine if you qualify for a mortgage, and if so, how much you can borrow. Over to you to give us some more information.
Okay, hi, my name is Elyse Bouwmeester and I work for Red and White Realty in the Waterloo region. Specifically, I'm in Cambridge. I'm going to tell you why this was created. So the new mortgage rules exist to protect borrowers like you. Interest rates are historic low and they can and they will go up. So the government just wants to make sure that you'll still be able to afford your mortgage payments when this happens. Otherwise, if you can't afford your payments and you default on your mortgage, you could risk losing your home. Mike, can you tell us a little bit about how this works?
Absolutely. I'll tell you first, at least one thing that hasn't changed, and that is your credit score. So ultimately, that's how they're going to come up with your rate, and that stays the same. But under the stress test rules, that won't be the interest rate that they're actually basing it on. What they're going to be looking at is as you just indicated, they're going to be looking at a higher rate. And, that's to ensure that you're going to be able to cover the mortgage when the rates, and they will, go up. So what will the lender use? Well, really in both scenarios. And when I say both, in uninsured mortgages, and those are mortgages where you have 20% or more to put down, or insured mortgages where you have less than 20%, it is going to be the weekly average of the 5-year rate on all mortgages plus 2%. And the other one is the rate offered by your lender plus 2%, whichever of the two is greater. And let me try for all of us to put that in really simple terms. So if you wanted to borrow $400,000 at the current rate at 2.5%, your monthly payment would be about $1,800. Under these new circumstances, you'll still have that rate, but you will be eligible. They will base your rate on $2,400 with the additional 2%. So that's an increase of $600 on a monthly basis that you'll have to show you have earnings that you'll be able to cover. And again, if your mortgage is doubled, it's $800,000, then that'd be $1,200. So this could be a game changer for some, right, Elyse?
Definitely. Yeah. So the bank's going to use 2 main figures. They're going to use your GDS and they're going to use your TDS. So your GDS is your gross debt service ratio. This is just a percentage of your monthly income that will cover your housing costs. So this includes your mortgage, your heat, your hydro, and your property tax. Now this percentage should be 32% of your income. We also have your TDS, so the total debt service ratio. This is any outstanding personal debt. So this can also include your mortgage, your car loans, your credit card debt, your line of credit. This should be no more than 40%. Okay, Davor, over to you.
Thanks, Elyse. Hi, everyone. My name is Davor. I'm a realtor here in Ottawa. I work for Waybridge Realty. And the first question I want to tackle is, what does the stress test mean for the borrowers? Going back to what the test was designed to tackle, and that's the household debt issue in Canada, the mortgage stress test essentially makes it a lot harder for mortgage applicants to qualify for the desired mortgages. What this means for the borrowers is something along the line of a reality check. The lenders are trying to make sure that the amounts you borrow is not going to make you house poor when the mortgage rates do go up. If you had your sights set on a home that is in an 800K range, perhaps you ought to consider a home in a 600K range because it might be more within financial feasibility for you. With limited supply and increase in demand, the change will add additional cooling effect by making it even harder than already is for the first-time home buyers to enter the market. So is there actually a way to sidestep the stress? The simple answer is no. The Canadian banks and other lending institutions are mandated to enforce these rules in order to limit their risk exposure. So what you can do is make sure your credit worthiness is on par, that you pay down your debts and save up more. And if you do require a mortgage that's in a higher amount, then get a cosigner. So this concludes our RE panel episode 1. I'm very excited about that. If you like our episode, please click on like and subscribe and let us know if there's any subjects that you would like us to tackle in the future. Thank you.
Bye.